Good morning and welcome to TOI Japan Market Radio. It's Monday, December 9, 2025, and I'm coming to you from Tokyo with your daily briefing on Japanese equities, currency, and rates. This show is designed for global investors who actively track or invest in Japan, bringing you the data and context you need to navigate these markets.
Thanks for having me. Let me give you the snapshot from today's session. The Nikkei 225 closed at 50,655.102, up 0.145%, so a modest gain there. TOPIX finished at 3,548, down 0.056%, so essentially flat with a slight negative tilt. The Mothers Index, which tracks smaller growth names, was up 0.145% at 2079, and REITs added 0.201% to close at 1992.0. On the currency side, dollar-yen is trading at 156.368, up 0.662%, so we saw some meaningful yen weakness today. Gold in yen terms fell 0.353% to 15,545, and crude oil ticked up 0.255% to 59.03. Overall, it's a mixed picture with narrow ranges in equities, but notable movement in the currency.
So fairly muted in equities, but the yen move is catching attention. Let's turn to the main story driving sentiment today, which is coming from the Bank of Japan. Governor Ueda has made some fresh comments about long-term interest rates, specifically calling the recent rises in those rates, quote, somewhat rapid. That language is important because it signals the BOJ is keeping a close eye on the pace of yield increases. Can you walk us through what's behind this and why it matters right now?
Absolutely. What Governor Ueda is highlighting here is the pace, not necessarily the direction, of long-term rate moves. We've seen Japanese government bond yields climb in recent weeks as the market prices in the possibility of further policy normalization by the BOJ. That's been driven partly by stronger inflation prints and partly by wage data that suggests the deflationary mindset in Japan is finally shifting. But when yields rise too quickly, it can destabilize financial conditions. It tightens credit, it pressures equity valuations, and it can undermine the very economic recovery the BOJ is trying to support. So Ueda's comment is a subtle signal that the central bank might push back if yields continue climbing at this speed.
And that presumably has implications across asset classes. How should investors be thinking about the impact on JGBs, equities, and the yen?
Let's start with yields. Ueda's language could act as a cap on further rises in the near term. If the market interprets this as the BOJ preparing to adjust its communication or even tweak yield curve control settings to slow the climb, we could see some stabilization in the long end. For equities, higher long-term rates are generally negative, especially for growth stocks and rate-sensitive sectors like utilities and real estate. If the BOJ manages to moderate the pace of yield increases, that would remove some downward pressure on the Nikkei and TOPIX. But if yields keep climbing despite Ueda's concerns, we'd likely see more weakness in equities. On the currency side, higher real yields usually support the yen by attracting foreign capital into Japanese bonds. If Ueda's remarks succeed in capping rate rises, that could limit near-term yen strength, which is what we're seeing today with dollar-yen up 0.662%.
So the BOJ is walking this very fine line between normalizing policy and not tightening financial conditions too abruptly. Now, staying with Governor Ueda, there's another set of comments from him today that touches on the sustainability of inflation in Japan. He's saying that higher wages will underpin inflation going forward. This feels like a significant shift in the BOJ's narrative. What's your take on that?
It's a crucial development. For decades, Japan struggled with deflation because companies were extremely reluctant to raise wages. That created a vicious cycle where consumers didn't spend, companies didn't invest, and prices kept falling. What Ueda is signaling now is that this dynamic has finally reversed. We've seen larger wage settlements in the past two spring negotiations, and companies are now more willing to pass higher labor costs through to consumers. That's the missing link in Japan's inflation story. If wage growth becomes structural and self-sustaining, It validates the BOJ's view that inflation will stay above their 2% target without extraordinary monetary support. That gives them more room to continue normalizing policy over time.
And presumably that has market implications as well, particularly for how investors position in Japanese assets.
Exactly. For equities, sustainably higher wages are actually supportive in the medium term. They underpin domestic consumption, which benefits cyclical and consumer-facing sectors. It also improves corporate profitability as demand strengthens. However, investors need to balance that against the prospect of further rate hikes. If the BOJ feels confident that wage-driven inflation is entrenched, they're more likely to continue tightening, which would pressure valuations. On the bond side, this points to continued upward pressure on yields, especially in the middle and long end of the curve. A steeper yield curve would reflect expectations of sustained inflation and gradual policy normalization. For the yen, this is moderately supportive. Higher structural inflation and the prospect of further tightening make Japanese assets more attractive to foreign investors, which should provide some tailwind for the currency over time.
So there's a constructive long-term story here, but with some near-term volatility as the market adjusts to this new regime. Let's shift focus now to the broader global backdrop, because what's happening in the United States is also influencing Japanese markets today. We're seeing renewed anxiety around Federal Reserve policy. Global equities have struggled, bond yields have risen, and that's creating a risk-off tone across markets. How does that feed into the Japan story?
Japan is extremely sensitive to Fed policy because of the interest rate differential between the two countries. The BOJ has only just started normalizing while the Fed has been in tightening mode for much longer, though the market is now debating how much further the Fed will go. When Fed anxiety rises and U.S. yields climb, it tends to trigger capital flows out of riskier assets and into safe havens. For Japan, that typically means a few things. First, Japanese equities come under pressure, particularly exporters who are sensitive to global growth concerns. The Nikkei's modest gain today of 0.145% suggests the market is holding up relatively well so far, but if global risk-off sentiment intensifies, we'd expect more downside. Second, we often see yen strengthening in these environments because of safe haven demand and unwinding of yen carry trades. Today's move in dollar-yen, up 0.662%, actually runs counter to that, which tells me the market is more focused on the rate differential story than on safe haven flows right now.
So the yen's weakness today is being driven more by the BOJ's cautious stance relative to the Fed's hawkish tone.
That's right. If the Fed signals it will keep rates higher for longer while the BOJ is concerned about rapid yield rises and wants to slow the pace of normalization, that widens the rate gap and supports dollar-yen. The other thing to watch is JGB yields. When global bond yields rise, there's usually some spillover into Japan, though the BOJ's yield curve control framework acts as a buffer. We could see modest upward pressure on Japanese yields, but nothing like the volatility you'd see in a market without that backstop. One risk to monitor is if the yen strengthens sharply due to safe haven flows, that could weigh on yields through deflationary concerns, because a stronger yen makes imports cheaper and dampens inflation.
So there are a lot of moving parts here, and the interplay between BOJ policy, Fed expectations, and global risk sentiment is really driving the day-to-day volatility. As we wrap up, what are the key themes you think global investors should be focused on when it comes to Japan right now?
I'd highlight three things. First, watch the BOJ's communication around yields. Governor Ueda's comments today suggest they're uncomfortable with the pace of rate rises, and any adjustment to yield curve control or forward guidance could have significant market impact. Second, keep an eye on wage data and inflation prints. If Ueda is right that higher wages will underpin inflation, that supports the normalization narrative and creates a more constructive environment for Japanese equities and the yen over time. Third, don't ignore the global macro backdrop, particularly Fed policy and U.S. yields. Japan doesn't trade in a vacuum, and shifts in the rate differential or risk sentiment will continue to drive near-term volatility in dollar-yen and Japanese equities.
Great summary. So for those of you tracking Japan exposure, The key is to balance the domestic story, which is improving with wage growth and inflation normalization, against the global crosscurrents from Fed policy and risk sentiment. That's all we have time for today on TOI Japan Market Radio. If you're a global investor following Japanese markets, consider subscribing so you don't miss our daily briefings. Thanks for listening, and we'll see you tomorrow.